Breaking a $400,000 fixed-rate mortgage to renew early with a Big Six bank can trigger a penalty of $15,000 to $25,000, according to a 2026 Pegasus lending estimate. The same break under the standard 3 months interest method would cost roughly $4,000 to $5,500. So that's up to $20,000 of difference hiding in one word: IRD. I read the fine print so you don't have to. By the end of this, you'll know exactly which method your bank uses and how to keep the bigger one from ever applying. Here's the simple version. A prepayment penalty is what your lender charges if you break your mortgage contract before the term ends, and the Financial Consumer Agency of Canada confirms this applies whether you're switching lenders or paying it off after a sale, but it's not one flat fee. FCAC says the penalty is usually the higher of two amounts: 3 months interest or the interest rate differential, and which one your bank picks changes everything. Let's start with the friendly formula. 3 months interest is simply your outstanding balance times your annual rate, divided by 12, then times 3. On a $500,000 balance at 4.5%, that works out to about $5,625, according to the cited penalty examples. It's predictable, it's small, and crucially, it doesn't care what interest rates are doing in the wider market. Hold on to that last point because the other formula cares very much. Now the expensive one. The interest rate differential, or IRD, is roughly your contract rate minus a comparison rate, times your balance times the years left in your term. The comparison rate is what the lender charges today for a term matching your remaining time. The whole point of IRD is to compensate the lender for interest income they'll lose because you left. So when rates have dropped since you signed, that gap widens, and your penalty grows fast. Here's why this matters so much. On a $400,000 balance, the 3 months interest penalty typically lands between $4,000 and $5,500, according to Pegasus Lending. But the identical mortgage at a Big Six bank can face an IRD penalty of $15,000 to $25,000 if rates have fallen, roughly 3 to 5 times higher. Same house, same balance, same bank. The only difference is which formula the fine print points to, and for closed fixed-rate mortgages, banks almost always choose the greater of the two. There's one more layer that catches people off guard. When you signed, your rate was probably a discount off a higher posted rate. When calculating IRD, many lenders use that higher posted rate rather than the market rate you actually pay. That artificially widens the gap in the formula and, per the cited disclosure practices, adds hundreds or even thousands to your penalty. In our example borrower's case, that a broker found a market-based comparison would have cut her IRD by $6,000 to $8,000. Before I get to the last part, which is the most counterintuitive piece of this, here's a rule almost nobody mentions. Under paragraph 10 of the Interest Act, once 5 full years have passed from the date your mortgage was originally advanced, the most a lender can charge you is 3 months interest. That statutory cap means IRD exposure has an expiry date. If you're near that 5-year mark, waiting a little longer can legally shrink a 5-figure penalty down to a few $1,000s. And here's the part that traps well-meaning borrowers. Say you break a $400,000 term to renew into a lower rate that saves you $200 a month. Over 24 months, that's $4,800 in savings. But if your IRD penalty is $15,000, you're roughly $10,000 worse off even after moving to the cheaper rate. That's why early renewal can quietly become one of the most expensive decisions a household makes. If this is useful, subscribe. The next breakdown is already coming. Now, the catch. The brochure won't spell out. That comforting word, renewal, hides the truth. For a closed fixed-rate mortgage, renewing early by switching lenders before maturity is legally breaking your contract. And breaking triggers the exact same penalty, 3 months interest or IRD, whichever is higher. So the routine-sounding decision to shop around and switch 9 months before maturity can quietly detonate the full penalty. It's not the switch itself that's the problem, it's the timing. Here's the flip side, and it's genuinely good news. Most lenders offer an early renewal window of about 120 to 180 days before maturity, where you can renew with no penalty at all, Vernon Road, as long as you stay with the same lender. Renew inside that window and negotiate hard, and you can secure a competitive rate for zero break penalty. Miss it or try to switch lenders during it, and the full IRD charge comes back. Knowing the exact dates of that window is the whole game. So what do you actually do? First, grab your latest mortgage statement and note your balance rate and time left in the term. Run both numbers, 3 months interest and IRD. through a Canadian penalty calculator and ask your lender in writing which method they use. A break and switch only makes sense when your interest savings comfortably beat the penalty, ideally by several $1,000s. For most fixed-rate borrowers facing a $15,000 plus IRD, that bar is simply too high to clear. If you take one action from this, make it a phone call. Ask your lender, what is my early renewal window with no prepayment penalty if I stay with you? And what are the exact start and end dates? Write those dates in your calendar and schedule any rate shopping inside that window, not months before it. Timing your renewal correctly and staying past that 5-year Interest Act cap where possible is how our example, a borrower turned an $18,000 penalty into zero. Understanding the difference between 3 months interest and IRD can be the difference between a $4,500 fee and a $20,000 one on the exact same mortgage. Next, I'm covering how variable rate mortgages dodge IRD entirely and the trade-off that hides. So if you want to catch that, subscribe so you don't miss it.